Thanks for being with us as we participate in this quarter's economic and market update, reviewing where we've been and where we're headed with our discretionary managed investment accounts run by the AMR team. With less than 2 months remaining in the year, or a little more than 2 months remaining in the year, please note that Kristen has been reaching out to many of you to schedule your 2025 required minimum distributions. For those born before 1960, you're required to withdraw at least a portion of your IRA once you reach age 73. This amount starts at around 4% and grows as a percentage each year. For those who are beneficiaries of an inherited IRA, you will have RMD requirements enforced this year by the IRS. Rules can be confusing, but we are reaching out if you have an RMD required minimum distribution. Even so, if you have any questions, don't hesitate to reach out. Make sure this is addressed for your needs. Each year, at various times throughout the year, we invite all clients to have at least one annual meeting. If you have not, but would like to meet, please reach out and we'll do our best to schedule time together before the year ends. As you know, Brian Regan, our team's senior portfolio manager, holds both a chartered financial analyst credential as well as a master's in business administration. Not only implements our trading, but also is at the heart of our strategy development. No doubt it's a challenging time this quarter for Brian to develop a plan for our portfolio positioning. On the one hand, we have markets racing to new highs routinely, and at least partly fueled by the enthusiasm around the potential dramatic impacts on productivity from and massive investment in artificial intelligence. On the other hand, there are some early signs of economic stress. To address this dichotomy of possibilities, let me turn things over to Brian to lead us through today's webinar.
Thanks for the introduction, Chris. It was very nice. Chris is right. There's a lot to go over. There's really a dichotomy in the economy going on right now, which we'll get into. But on the positive side, the artificial intelligence economy is booming and really driving the economy. On the negative side, we have tariffs, student loans, and immigration really affecting the economy in a negative light. We're seeing just stagnation in employment. We're seeing the yield curve change dramatically with the change in Fed funds, with inflation expectations, and we see that I think that's going to create some opportunities for us that we want to take advantage of. We're going to talk about the expected growth in the economy or lack thereof, and think about how that's going to all play into our portfolio positioning. So this quarter, I put it a little bit in a letter that went out a week ago in your inboxes. But what I want to talk about really is how all these drivers make it into our portfolio and how it's making the decisions happen. And hopefully when we get through this, you will understand on a more intimate level why each ticker is in your portfolio, and that's really the goal. We don't want any surprises here. We want you to understand that everything is in there for a purpose, and the point of these presentations is to talk about that purpose. So let's get right into it. The first thing I wanted to point out is this is a consensus expectations chart from Bloomberg. I'm gonna show this and highlight different things as we go along. The first thing I wanted to point out was the probability of recession is 33%. That might seem pretty high, and it is pretty high. And I want to start off by talking about why that is and how the market could be doing really, really well at the same time. And that Chris mentioned that this is a bit of a struggle this quarter, and that's really the crux of it, right? How could we have a part of the economy that could throw us in a recession and another part that's driving markets higher and yields lower? Well, what we're seeing is this K-shaped economy, right? We got artificial intelligence spending is driving the economy, 3+%, and some of these policies around tariffs and student loans and immigration are dragging it down about 2%. So on the whole, their expectation is about 1% growth going forward, and we'll talk about that more going forward. But obviously, if we see improvement in the bottom half of that picture, that's great. If we see improvement in the top half of this picture, that's also great. If we see, I think what a lot of people are worried about now is that top piece that's really driving the economy faltering some. And so far, so good. There's not really much evidence at all that could falter, but I think it's prudent for people to look for cracks constantly, and that's one of the things that we're doing on a regular basis. We also just don't want to be too aggressive. We don't want to completely lean into that artificial intelligence piece and ignore the bottom half, which is undoubtedly a drag on the economy. And I'll show some data here to back up that claim of mine. So first, the good thing, right? The artificial intelligence economy. And any given year, to put this in context, the economy is expected to grow about 2% in real terms. 2% on $30 trillion is, let's call it $500 billion in potential growth in the economy in any given year. These four companies are spending $350 billion in CapEx to grow out their data centers and their AI capabilities in 2025. And that number is expected to grow. So we're talking about four companies generating almost all of the expected GDP for the United States in any given year. So that scale can hopefully give you an idea of why the economy is continuing to move forward, and the stock market is continuing to do well. Now, it's important to understand that they might be spending $350 billion, and it might just be those four companies, but that money is so wide-reaching. And if you think about what it takes to build a data center, and right now there's more data centers under construction than there are data centers, period. There's construction and engineering that goes into it. There's a necessary build-out for the power grid. Of course, there's a need for semiconductors and servers, but also semiconductor design, equipment manufacturing for semiconductor manufacturing. You need certain services and consulting to maintain the data centers, since they can be the size of Manhattan and require similar power needs. At the same time, you're going to need cybersecurity as this data scales to end consumer companies like Tesla, for example, is trying to build robots or automated vehicles like what Waymo's doing. So it has far-reaching tentacles. So these four companies are spending a lot, but the economy is much bigger and robust than might be assumed just from this chart that shows these four companies, which really are supporting the growth in the economy right now. There's been a lot of concerns recently about vendor financing and how it's similar to 1999, where back then there was maybe agreements. Hey, I'll buy advertising on your platform. You buy advertising on my platform, and we'll all be better off in the end for it, even though it's a wash sale, right? And I think it's a reasonable thing to be kind of concerned about. And people have called it circular. People have called it vendor financing. But when you really break it down, the crux of this to me is, can OpenAI raise the money it needs to build out the infrastructure that they have ambitions to do so? And they have a $300 billion deal with Oracle, for example. $300 billion to spend with them between now and 2030. That's obviously a ton of money. The estimated value of all of OpenAI is only $500 billion. But that is over 5 years. They are growing enormously. They're a private company, so it's unclear how much money they really have, but numbers of $1 trillion IPO have been thrown out. They are going to be able to borrow money against that revenue. They're going to be able to borrow money against that expected equity that they're going to raise. So as long as the capital markets are open, I think this circular economy can work. And I think the capital markets will be open as long as there's a robust need for compute, which so far we've seen no evidence that there will be a slowdown for compute needs for this economy. So to give you a kind of a fuller picture of what's happening and how much this is driving uh, parts of the economy beyond computing, right? Beyond infrastructure, software, and semiconductors. Look at this construction spending chart. More money has been going into electric power and data centers than in office buildings for the last few years, and not by a small degree, right? That slope of that line from the data centers and the slope of the line for office buildings is pretty remarkable. And that electric power is one of the reasons why we've been in utilities for 2 years, right? We've seen this big boom in construction need, and CapEx expense and construction expense is good for utilities, generally speaking. So you can see how this is a wide-ranging. It's not completely as focused as many people would lead you to believe, but this is more robust in the U.S. economy than typically might be expected. We've seen this chart before. This is the data center growth provides a boom in the energy demand. I'm just putting an exclamation point on that, reminding people again why XLU has been in your portfolio for almost 2 years. We love this theme. We're getting something that's historically been, a relatively safe investment for equity, something that reacts to lower interest rates, which we're also getting, and it's also getting, some robust expected revenue growth, which is out of the ordinary for this. Let's look at the flip side of the economy, right? So tariffs, student loans, and immigration. Tariffs, the estimates I'm seeing are wild, anywhere between 12 and 18%, and it's changing regularly on what we're expected to have for an effective tax rate on tariffs. If you do the 15% calculation on the total imports in the United States, you'll get something like $700 billion, which far surpasses that potential GDP number of $500 billion, right? Some companies are expected to find ways around it. Some companies have been carved out. Some things have taken things to margin, and some of it has been paid by the consumer. And the expected end tax that Fidelity comes up with when you take all that into account is about $250 billion. It seems reasonable to me. Still a very large number, still about half of the expected GDP in any given year. So this has been a drag. There's to me, not really much of a doubt. The question is, where has it hurt us the most, or at least where we see the pain? And what you really see in this chart from Apollo here is that in electronics and appliance stores, furniture and goods, sporting goods and bookstores, really the nuts and bolts of the economy rather than the bits and bytes have been the things that have been hurt. I think as we go on, we'll see some more things that might be affected, especially as you've seen inflation tick up, and we'll get to that in a little bit later. There's only so much that you can raise prices until people just pull back. Now, probably more importantly, a lot of the tariffs have led to other countries, coming back at the United States. And one of the big ones is China has a near monopoly on rare earth metals, which are very important for important industries in the United States, from electronics to medical equipment to defense. And on the left-hand chart, you can see the rare earth metals and how much the U.S. is reliant on them. And all the way, to the right of that left-handed chart, you could see what is made with those rare earth metals. And you can see that these are things that seem very, very important, from medical lasers to nuclear control rods to cancer treatments, to night vision goggles, to nuclear reactor and small motors. This is important. Now, on the right-hand side, I was surprised at this, and this is from JP Morgan's Eye of the Market, from Michael Sembalist, who I think is one of the best analysts I follow. He shows that the Chinese industries is they're less dependent on exports to the United States. So we might not have the leverage that we expected on China because of these rare earth metals, and because I think they've done some work to move their economy away from reliance on exports in the United States. Now, ultimately, I think this is probably going to be, this fact might be a good thing, because it might make it so we have to come to the table, right? It's really hard to play hardball when you absolutely need certain things that a country can trade with you. And this has led to the government getting more involved in industrial production in these rare earth metals in the United States, which ultimately will probably be a very good thing for us. Now, where is the evidence? The red line that you see going down the middle of the screen, that is, I'm trying to estimate when Liberation Day is. So you can, these are certain stocks that I cherry picked based off of that data that says who's being affected by this. And it's apparel, it's car sales from CarMax, and Best Buy hasn't done well, and Gap hasn't done well, and Dick's Sporting Goods, and Ethan Allen Interiors. We know that the S&P 500 is up about 18-19% so far this year, and CarMax is down 47%. Best Buy is down 14%. Gap down 14%. Dick's Sporting Goods down 6%. That's a pretty big change in expected performance between what's actually happened, driven by the artificial intelligence economy, and kind of these Main Street names that I think most of us are familiar with that have done very, very poorly this year. So student loan delinquencies, for those of you who are unfamiliar with the story, in 2020, in March of 2020, payments on federal loans were paused. In October of 2024, they were restarted again. Normally, it shouldn't be an issue, right? But for 4 years, people basically got used to not paying their student loans. What did they do? Well, they did things like shore up their balance sheet, pay down other debts, and that helped their credit scores. And those credit scores led to increases in housing demand, which we saw over the last few years, right? As housing prices have gone up 5% compounded annually a year for the last 5 years. We saw car sales do relatively well as better credit scores leads to more credit availability. Now, what did we see? What happened in Q4? We saw massive delinquencies in student loan. The switch got turned back on, and the people who were delinquent were becoming delinquent again. At first look, this doesn't look too bad, but I'm talking about the red line here. It's kind of getting back up to that 10, 11% that was prior to the pandemic, right? The problem is with those credit scores that got so much better. Now, when somebody looks like maybe a prime borrower, they might start to look like a subprime borrower. Especially when you look at the credit cards, you're seeing the same kind of story play out. Auto loans, you're seeing a similar story play out, although not as extreme. So what do we see when credit scores go down from not paying their student loans? Well, you can lose 160, 170 points, and that's significant. That puts you from prime to subprime. You go from prime to subprime, well, your borrowing power, it gets hit significantly. So not only are 10% of the people delinquent, you're paying between 5 and 10% now on $42 trillion worth of outstanding loans. That's going to be a drag on the economy from what it was prior. Let's keep that in mind when towards the end, we're going to look at the growth of the economy in 2021, 2022, all through now, and what's expected going forward. And these drags are going to get filled into the consensus expectations pretty clearly. Now, immigration and deportation, over 2 million illegal aliens are out of the United States in less than 250 days. This is straight off of Homeland Security's website. The administration is proud of this. This is one of their goals. I'm not going to talk about whether I think it's a good thing or a bad thing. What I'm going to talk about is how I think it's going to affect the economy. And the reality is there's some industries, wholesale trade, transportation and warehousing, construction, retail trade, leisure and hospitality, which are heavily reliant on unauthorized labor. And what I would expect is that either the level of service or wages and subsequently prices in these industries to go up pretty significantly. And I just think that's inevitable when you take out the labor component here. So we haven't necessarily seen too much damage here. We've seen services inflation go up a little bit, which isn't ideal since we had seen it go down. We have seen goods inflation go up, which we talked about a little bit earlier, which isn't great either. But ultimately, this is just a drag to the tune of around $70 billion a year on the economy. Now, again, Tariffs 250 billion. Immigration and deportation around 70 billion. It's really hard to nail down that the impact of the student loans. But we're starting to kind of erase that boom that we were having from the artificial intelligence, right? And that's why we're really expecting about 1% growth between 2026 and 2027. It's not going to be that robust. It's going to be fairly muted, and that's also why we have that 33% expectation of a recession. Now, where have we seen this? Again, the red line is where Liberation Day is, and these companies I'm highlighting here, these are called BDC companies, but basically the private credit, private equity companies. They are financing the smaller, more niche companies in the world that are going to be more affected by these types of policies, right? They're not participating as much in the or as directly in the artificial intelligence community. So, these stocks have done very, very poorly, right? We're seeing starkly negative performance from them. We've had some really high profile blowups in some auto parts suppliers recently in First Brands and Tricolor. And I think that's all part of this story, and it's something to keep an eye out. And one of the reasons why we've avoided private credit, because I do think it's much more likely that we're going to see more of this going forward, or at least significant declines in expected returns in those types of assets. So let's talk about employment and how Liberation Day has affected that. So we didn't get the last unemployment read because the government is shut down, but we have seen a tick up in unemployment. Not too much to see here when it comes to data points post-Liberation Day. Sure, it's a little bit higher, but really hard to tell without more data, which kind of brings us to another point though, right? If the government continues to get shut down, it's hard to quantify this, but it just can't necessarily be a good thing. One, for transparency; two, for people not getting paychecks. They're going to get back paid. At least that's the law. But right now they probably have to be very careful. Continuing claims have gone up since Liberation Day. Also not good. The analogy that I like to use here is there's not a whole lot of firings going on. There's not a whole lot of hiring going on either. So if you were to think of the unemployment situation as a bathtub with a dripping faucet, right? It'll fill up in time, but it's happening slowly. So, we can see this through U.S. job openings. There's not many open compared to how there were, a few years ago. I've highlighted in the past that, one of the things I would be more concerned about is construction jobs, because it's cyclical. It takes up a big portion of the economy. And we have seen dramatic falls in particularly residential construction jobs. I'm hoping that kind of gets moved over into the AI side of the economy, where we still need a lot of things built, just not necessarily residential houses, since that part of the economy is clearly in recession mode right now. And ADP is a big payroll processing company. We are getting data from them, and the last data point that we got from them was a negative one. We had negative $32,000, negative 32,000 jobs in the economy. So 32,000 people lost their jobs, according to ADP, in the U.S. economy in the last quarter. So, we're not adding any new jobs. At best, this is, stability. But obviously, we want that number to be higher. One of the things that we are going to change this quarter is adding something called the dual direction ETF. Now, it's an option strategy, and if you're really curious about it, we can talk about it offline in more detail. But what we really want to have in this alternative space is something that could possibly be positive if things turn negative in the stock market. And what does that do for us? Well, if I am going to have a positive returning asset when things go down, it allows me to take more risk on the stock side. And that's something I really want to do, because we've been a little bit underweight since Liberation Day, and I'd really like to get back to neutral. But I don't want to do so irresponsibly. I want to achieve two things through the alternatives part of your portfolio. I want to decrease risk for the portfolio, but I also want to deliver some return. So what you usually do is you look for something that is not correlated at all with the bulk of your portfolio. And I think that's what this asset really does. It will participate some of the upside, but it will actually benefit a little bit on the downside. What I think in practicality it will do is deliver a very, very low volatility with a positive payoff, much like, maybe a similar to a cash-like instrument, which we're moving away from completely in JPST, which has done that for us over time here. And the reason why we're making this trade-off between a JPST and this dual direction ETF is JPST is going to pay us less going forward because Fed funds is coming down, and this could possibly actually deliver us a positive return in down market where JPST would not do that. It just wouldn't benefit on the capital gain side. It just wouldn't necessarily go down. So that brings us to the flip side of the portfolio that's really more concentrated on the yield curve and the deliveries that the changes in inflation and yields, the opportunities that can drive for us. So I mentioned a little bit before that inflation is no longer your friend. Again, the red line is Liberation Day. We can see that the decline in inflation kind of abruptly stopped there and started ticking up. We recently just got another unfriendly inflation reading, less than feared, but not great. So the trend is reversed on us. We know, I've shown this many times in the past, the policies that we're pursuing are going to lead to higher inflation. And what does that mean? I think it's going to lead to a bull steepening yield curve. So what's a bull steepening yield curve? It means I think the whole yield curve is going to come down, but the front of the curve is going to come down faster. And you can kind of see that. So the blue line is the last close from when I pulled this chart. I believe it was 2 weeks ago. And you can see on the right-hand side of the chart, it's above that yellow line. And that yellow line is what the yield curve looked like a year ago. And at the front end, it's much below the yellow line. So we're seeing this bull steepening happen. As Fed funds gets lowered more, as the Fed tries to defend against those employment concerns, and inflation continues to be high, I would expect us to hang around at least that 4% zone on the 10-year. And I think we could go much lower on Fed funds unless that employment picture starts to
Brian, before you move on, I just want to clarify. I think we've gotten questions from clients about the commentary about inflation, and just probably worth a moment of clarification. When you say that inflation is likely to be high, you're not suggesting that it's going to be as high as it's been in 2022 or anything we've seen. It's just higher than the Fed's target rate that they've been aspiring to, which is 2%. And it seems like, we're consistently higher than that 2% target. Is that fair to say?
That's absolutely right. So 2% is the target. We're north of 3% plus right now, much higher than where we want to be, right? And not only that, the trajectory has changed. So I'm not saying I have an estimate on where I think it's going to go. I think a lot of things could change. I think it's very, very hard to make that call. But what we'll see is the consensus is going to be around 3% in the out years. And we'll see that at the end. I'm going to point that out. But yeah, 3% over 2%. I'm not expecting this to go, 7% again, like we saw there in the core.
Yeah, and therefore the shape of that yield curve is likely to be different as you look ahead.
Yeah, and if inflation goes much higher, well, they're going to have to start cutting Fed funds, and then we'll have to reevaluate that. That's one of the reasons why we do this quarterly. The world changes, we need to change with it. And it's also why we believe that having some active management in your allocation is useful. Thanks. So what kind of opportunities does this provide, right? This is a chart of the 10-year minus the 3-year Treasury yield spread. So this is just a way of saying how steep is the yield curve. Right now we can see it's basically flat, right? It was inverted over the last couple of years. Now it's basically flat. So as this purple line tends to go up, regional banks tend to go up with it. And why is it? Because they get to pay less on their deposits to you, and they're still earning a spread on their loans. So their net interest margin goes up, basically meaning their profit goes up. This doesn't work as beautifully for the big banks that we might all know because they might have different lines of business. So, they might be more impacted by sales and trading or investment banking or things of that nature, advisory services, where this is really a net interest margin based on lending to Main Street kind of idea. Now, the obvious problem with this, right, when going too much into these regional banks, is if the economy were to slow down significantly, you would see defaults. And we have seen defaults. Now, I think the defaults are going to be predominantly in those private credit type markets that we've been staying away from. But you can't go, just like everything, right? We can't go all in on the AI theme. We can't go all in on the regional banking theme either, even though I think this pattern here we're seeing, on this technical chart is convincing, and the fundamental story that goes with it is also convincing, but we're going to be reasonable about it. You're not going to see an overwhelming allocation to regional banks, but we are going to, add that position, that KRE position. Now, what also, I've written articles about this. It's online. It's online on our website. Maybe if you're interested in a deeper dive on what I think drives gold prices, I encourage you to go read that. But in short, I think global interest rates have a big effect on gold prices. Now, there's two red lines here. The first red line on the left, that shows when we went into gold the last time in our discretionary portfolios to any significant degree. And we did well on it, right? Global interest rates started to come down. They were near zero. The gold line is the ECB rate. The purple line is the Fed funds rate. So the major currencies were going closer to zero, which for me, gold is a global currency with a 0% interest rate. So if other currencies aren't paying an interest rate, gold becomes much more competitive against them. So now as Fed funds is coming down again, I would expect gold to be more competitive. Now, gold has obviously been on a historic run lately. Part of that's been because of central banks. I really have no expectation for that to change. It could. It's something that we need to watch. It's a risk to this idea, right? And I think part of the 8-9% sell-off we just had was part of that kind of unwind of enthusiasm, investor enthusiasm, that's been part of this gold trade lately. But I think if my thesis holds true, which statistically, it makes a lot of sense, we should see a continued increase in gold. And similar to the regional banks, it's going to be a responsible position. We're not going to have, a crazy amount, but I think it's a good time to get back involved, especially as we're seeing, you can see the ECB's has been in a cutting cycle. They're on a little bit of a pause, but as their economy starts to suffer a little bit, they might start cutting again. Fed funds is very much expected to be cut again here in October and a couple times again next year. So this is one of those things that's sensitive and you need to monitor it. But I think now is a good time, a good argument based on my interest rates case to add some exposure to gold. So growth, this is when I mentioned that we're going to sum it all up. We're going to bring all this back around to see what is the consensus expectation. Well, we know the probability of recession is at 33%. That's the consensus. That's not mine. You look at 2021, right? 6.2% growth. That was outrageously high. But in 2025, 2026, the consensus is 1.8. I think that is generous. And why do I think that's, I'm happy that it's close to potential, but I do think it's generous. And why do I think it's generous? Well, you can see that it's driven by private investment. So 2024, you see that 3%, where you were getting, 0.8% in 2023. You were getting, 3% in 2019. But that's the driver right now, that private investment. And that is the AI economy. We could see that slowing down in 2025 and 2026. So that's something to monitor. We can also see inflation close to 3 and close to 3 for the next 3 years. Now, that GDP number is a real GDP number. It's after inflation. So if inflation is high and keeps getting higher, well, your real GDP is going to come down. That's just mathematically how it would work. So that's another reason why I think, that 1.8 it's not a great number to begin with, but I think there's a good reason to believe it's a little generous, especially with the probability of recession at 33%. What is all this data telling you? Well, it's telling us that a lot of possibilities can happen. If you think of something, from like a z-score type chart, we have a very flat chart right now. The tails are fat. Negative consequences and very positive consequences could both happen, with heightened probability, and that's makes things a little bit more difficult to navigate, and it makes it so you can't take an enormous amount of risk, but you also can't be super defensive. You kind of have to find a barbell approach where part of your portfolio is defensive and part of it is leaning into the things that are doing well. So how are we doing that? How are we doing that barbell approach where we're being a little bit defensive and leaning into the things that are doing well? Well, from the equity standpoint, we're going to continue to lean into that AI economy. We're going to continue to hold the growth, the semiconductors, the utility positions, but at the same time, we're going to continue to hold a value and low vol position. We're going to add a regional bank emphasis. It's a little tough when you look at those value and low vol returns, right? Because they haven't been great this year. But the reality is we can't allocate based on what's happened in the past. We have to think about the probabilities of what could happen in the future. And the probabilities are there's a bigger tail risk of something bad happening than there typically is. And that's what we see from that consensus 33% recession probability. Alternatives, we're going to do the dual direction ETF and goals. I talked about that and why we're doing that, but I think that is going to give us some added diversification, and possibly some nice return in that alternative space that we're looking for. And finally, in the fixed income, we're going to extend duration and credit quality, but we're also going to maintain an inflation protected position, which I think is important when we're seeing the dynamics that we're seeing between growth and inflation right now. Happy to take any questions.
And if you'd like to ask a question, we've got two buttons for that. The chat is probably the easiest. Just post your question right in the chat format there. But there's also a question box if that's easier. And we'd be happy to entertain a few questions while we do wait for some of those questions to be posted, should people have some. Brian, there's a few things that might be worth revisiting. One of them, you made some comments about government shutdown, but it's certainly on people's minds, one of the longest government shutdowns. Yet, unless you're a government worker affected by this, it seems as though things just keep moving on, and it seems pretty modest in its consequence right now. What comments would you make as far as how the government shutdown might influence concerns or outlook as we review what you talked about today?
Yeah, I don't think about it very much, and this is why they're going to get the government workers have a history of this happening, and then they basically get a long vacation and then they get back pay. There's always a chance that this gets way out of control and it extends much longer, or as was floated a couple weeks ago, they don't do back pay, which would be quite literally criminal. But that's why I don't worry about it, because it's temporary. And when you're investing, you try to think of longer term trends rather than short term blips. Otherwise, you kind of drive yourself crazy. Now, if it keeps extending, it'll become a longer term thing, right? And you kind of look for changes in the government, that could alter that idea one way or another. But yeah, I think I don't really think it's responsible to put too much emphasis on that in your decision making.
Great. We had a question. Well, I have a few others, but I'll go to our Steve asks, are there any tax strategies here at year end? Might be an opportunity for you to talk about within the portfolio confines what you do routinely to address tax planning in terms of capital gains, capital loss harvesting, and so forth.
So sometimes there's a lot more opportunity for harvesting gains than others. So as you can imagine, after on the back of a few good years, we've had a good year this year. There's just much less losses in portfolios. There's not too much to do. But every quarter, and I do it quarterly because you can't really you can take losses, right? But then you can't buy it back for a certain amount of time. And any kind of substitute I put in there, unless it's like a treasury ETF where I can swap out one treasury ETF for another, there could be give up in return. We have the
Discrepancy.
funds
Yeah.
we have the funds we have because we really like the funds we have. So I like to get people back into them, when they can. It's a little bit easier in the individual stock portfolio to be more aggressive in tax loss harvesting, because I can swap out one stock for another stock that is, in the same industry or very similar in nature. If you have that portfolio, you know what I'm talking about. You've seen me do it all throughout the year. But every quarter we look for it. We don't just do it year end. We do it regularly, and we're trying to take losses. Now, if you have a position that has a $200 loss, $300 loss, well, it might not make sense for me to take that loss because the benefit might be too small based on what you're giving up, in the possible changes in the portfolio return over the next 45 days so I can avoid a wash sale. So we do everything we can to take responsible losses in your portfolio. But it's just harder when you do really, really well. There are some solutions that Chris and Russ have been pursuing for clients, whether it be the Vice portfolio or the AQR, which has been pretty effective for people, but probably not suitable for everybody, and probably on a case-by-case basis. And when you have your regular meeting with Chris, and that's something you're interested in, I would suggest that you bring it up.
Yeah, as far as other things, I mean, it's as we think about this time of year and tax strategies, naturally, we do often talk to people about whether a Roth conversion is worthy of consideration, and similar kinds of, whether we want to be trying to doing some intentional tax decision making. When it comes to the portfolio specifically, though, Brian, it might be worth mentioning that most of the equity exposure we provide, whether it's, and this is in the fund strategies, ETF mutual fund strategies, they're mostly done with exchange traded funds, not exclusively, but mostly. And therefore, we're not as concerned about acquiring embedded capital gains, which is sometimes a worry in a mutual fund because it's often the case where mutual funds distribute capital gains late in the year, and we have to be mindful of that. In the way we do things, we have tried to structurally position ourselves where that's not a great part of our worry, because the way we select what we select. But those are a couple of things that come to my mind when it comes to year-end tax strategies. And of course, as Brian said, there are some other things that we can be looking at. And if there's a big issue in your case, the kind of tax bill you're dealing with, we're happy to talk more about it. When it comes to the use of municipal bonds, by and large, so there are exceptions, but unless you're in the highest tax bracket, we're reluctant to use municipal bonds because we don't think you're going to actually net the benefit on an after-tax basis. When it comes to another question, Brian, we have a question from Ray. He's looking for us to talk a little bit about bonds and to go a little further in talking about duration and the virtues of like why it is, or what are we thinking when it comes to the how far out we're looking to go with our bond purchases when it comes to the term and what's optimal.
Yeah, it's a good question. So generally speaking, if you were going to be super aggressive in pinpointing our duration, which we use mostly funds, so we're not super aggressive. We let the funds have some leeway within a couple of years. you would want to pinpoint what they call the fat part of the curve. So basically the part of the curve where you're taking a relatively small amount of interest rate risk and achieving the most amount of yield. Right now, we believe that's around 3.5, 4 years, maybe a little further out. So, that's what we're doing. Our mid-range, funds, the DODIX and the SBTI, they're taking around 6 and 7 years in duration, really between 5 and 7. The SBTI, the DGIT, that's around 7. The DODIX is closer to 5. USTP is between 1 and 3. So that's making up the bulk of your portfolio. The weighted average is around 3.5, 4 years. So the idea is we think we're going to achieve some capital gains if yields on the longer term continue to come down, which we've gotten. DODIX and SBTI have done very, very well this year. But if we have to be cognizant of that fact that inflation is high and getting higher. And if the Federal Reserve decides to change their mind anytime over the next, let's call it 2 years, we're not going to get those capital gains that we all love. So you have to be shorter on the curve as well. So, similar to how we want a full barbell strategy on the total portfolio, you kind of want an internal barbell strategy on the fixed income portfolio, where you want some on the short side to defend against surprises from the inflation tension. But you also want to take advantage of that weakening employment situation and getting a little longer. I think the most important thing is staying high in credit quality, which, there's really two functions of changes in interest rates. It's the benchmark interest rate, which is the Treasury, and also the credit spread. So we don't want to take too much spread risk. We want to be up in quality, so we're not exposed to too much interest rate risk.
Brian, one of the things I wanted to ask about relates to the recent bankruptcies of First Brand Group's Tricolor Auto Group. And this is widely discussed, and you've talked about the concerns about private credit. Comment about this worry for potential for systemic risk, and maybe further, do you worry at all that a regional bank position is connected to that kind of a risk, or why not in this kind of a consideration?
Yeah. So First Brands was maybe a $5 billion bankruptcy. JP Morgan had $170 million worth of exposure. Jefferies had a lot of exposure. It was like a lot of syndicated bank loans that were happening here. Every BDC has come out in media and said this is idiosyncratic, nothing to see here, fraudulent. In my experience working in the space, a lot of these distressed borrowers, they border on the edge of fraud and reality a lot. And to me, I kind of agree with what Jamie Dimon said, and that when you see one cockroach, there's probably more. And it did affect some regional banks within the last couple of weeks. And we did get a little bit of a sell-off in the regional bank area. But I do think most of this risk is in that private industry area. So why do I think that? Well, we saw private credit explode following the financial crisis. So for the last 20 years almost, these creditors have taken where the banks can no longer take that kind of risk capital, and they've ran with it. And the fees are really high, and every single conference I go to, people are pitching it and they're stuffing it in their clients' portfolios. And so far so good, but I have a healthy amount of skepticism on the credit quality of those things. And if you have multiple managers, it's something I'd keep an eye out for. We don't have any of it in our client discretionary managed portfolios, so that helps me sleep at night. Again, I want to be up in credit quality, but I think it's something that we need to watch. I think it would be very hard for this to be a systemic issue, partly because you have to be somebody of size. I don't think it's infiltrated the banking system the same time that's subprime did nearly 20 years ago. I think this is mostly corporate, mostly smaller businesses, but that doesn't mean it can't be damaging. And it is something that I worry about every day. That, and I think the leverage in the cryptocurrency market are the two where I think most easily observable risks in the system right now.
And you had some pretty successful tactical trades earlier in the year around relating to what was going on with the tariff decisions, and they were temporary. You held them a very short period of time in one instance. You talked about some alternative positions, possibly including gold in this alternative strategy that uses options to potentially make money on the upside and potentially make some money on the downside. With regard to these, maybe talk about sizing in part, and then two, do you worry about being late in the game when it comes to this gold position, as gold has done quite well? And how are you thinking about how it'll be used in our strategies?
So when it comes to sizing, we've been underweight equity since April, and we've been overweight alternatives, and that's been purposeful, right? We thought with the risk to the downside being so high, we didn't want to take as much equity risk, but we also don't want to give up return, obviously. So we tried to make up that return in the alternative space. And we've been in the Power Buffer ETF. I did something I've never done in my entire life and bought the VIX when things were getting crazy back in April. And the alternatives have delivered us, a 12.2% return so far this year, give or take, which I'm very pleased with. The stock market's done better, but I do think that we were cognizant of that tail risk. And now with a crystal ball, we would have known that probably would have been much better to be overweight as things changed over time. But I don't regret that. I'm happy that we were able to add some real value in the alternative space and something that took much less risk than the stock market, or at least conventionally I would expect that buffer ETF to be less risk than the stock market. When it comes to gold, I'm thinking about 3 to 4% in any given strategy of the portfolio. We're going to use the ticker GLD. We've used it in the past. Hopefully people are familiar with it. When it comes to the run up that gold has had, sure. I mean, listen, it's a very, very difficult thing to value. It doesn't have any cash flows. It's basically a pet rock, right? That some of us wear on our fingers, and it's in some industry. But the reality is that it is viewed around the world as a backstop for currencies, and central banks have been buying it ever since the Russian-Ukraine war. And one of the reasons why I haven't been interested in it is because there are a lot of theories on why gold changes in price, and most of them are wrong. And I'm not going to get sucked into the media headline of the day, which doesn't really make a whole lot of sense. And when you study the actual price movements, it acts very much like a currency with a 0% interest rate. So if it doesn't really have an intrinsic value, and it's really about the relative value versus other currencies, well, then the opportunities should get better as interest rates come down. The real risk in my mind, aside from the short-term trading, which we've seen it fall 8-9% in the last week, would be inflation and the recovering job market causing interest rates to rise, and for global currencies to become much more competitive against gold. To me, that's the bigger risk, although anything can happen on short-term trading.
A follow-up question regarding the bond positioning, and particularly about treasuries, and just in general terms. Do you like the idea of a long-term treasury bond? The TLT was mentioned in particular. Or do you consider that to have too much risk, or a good place to be? Like, do you like the idea of going really long out on something like a treasury, or why not?
No, I think it's way too much interest rate risk. TLT has some wild price swings, so it's not appropriate for most people, and I think you're really betting that long-term interest rates would come down. And if you actually go back and we look at this chart, I'll show you. We look at this chart, you'll see that long-term rates are actually going up, right? So if you look at the far right side of that blue line, that last close is above that 1 year ago. So that means TLT's lost money. Despite interest, you would have made money being almost anywhere else on the yield curve. But if you would have bought that longest part of duration, you lost money in the last year. That's not ideal. It's too much risk. It's almost impossible to have any kind of estimate of what's going to happen with interest rates between now and 30 years from now, and to me it's not worth the gamble. We bought TLT once in the past. It was during the pandemic. I do have a history of trying to take advantage of really crazy pricing during really stressful times. And, that's what we did with that VIXY in April. That's what we did with TLT. That's what we did with the muni bonds back in the pandemic. I'm going to continue to do that, but that was really an attempt to take advantage of a really extraordinary situation.
Yeah, and something tactically oriented.
Mm-hmm.
Brian, this has been great. Thanks for the hour went by very quickly. Thank you everyone for being with us and for staying for the full portion. Obviously, if you have questions as it relates to your own circumstances, we are more than happy to be a resource to you. Please do reach out to our team. And in the meantime, thanks for being with us. And if you have questions, reach out. Okay, until next time. See you, everybody.